Today I want to go over 5 tips when looking to qualify for a home loan. These are things that I would be doing right now if I was filling out an application and looking into purchasing a home. My name is Drew Smith. I'm a licensed loan officer at Military Home Spot Lending, NMLS number 2113580. While I do specialize in VA loans, I've got access to everything as far as conventional, FHA, USDA, VA, and even some non-QM products. And then a cool thing that we're actually doing that not a lot of other lenders are doing, and that is new construction loans. So be happy to look into those for you. But now let's jump into what I want to talk about today. And these are my 5 tips when looking to qualify for a home loan. And the first one is credit. You need to know what's going on with your credit. The best way to do that is to run your own or pull your own credit report. Yes, as a consumer, you can do that. You are entitled to 1 free credit report per year, and I think that's actually plenty to give you a good idea of what's going on your credit report. How you can do that, you can sign up with each of the 3 credit bureaus, Equifax, Experian, TransUnion. You can go to their individual websites, you can sign up, you can create an account, and you can get one of your credit reports. You can also go to freeannualcreditreport.com. So there are ways for you to get your credit report. Now, once you get your credit report, what are you going to be looking for? What should you know about that? So obviously your credit score, right? That is going to be a big issue. A lot of loan programs require a specific credit score. So conventional typically is looking for a 620. FHA is looking for at least a 580. VA, there is none, okay? And USDA, there is also no minimum credit score requirement. Now, for these 2, that doesn't mean that lenders can't put what's called an overlay, which they would require a minimum credit score for that product. So, traditionally, if you're looking at the guidelines for VA and USDA, there is no minimum credit score requirement. However, other banks, lenders, they might require something there. And then conventional FHA, you're looking at a 620 or 580. So credit score is one factor that you are going to want to look at when you pull that credit report. But what is a credit score made of? It's a rhetorical question. Those are your trade lines. So your credit score is based on your credit history and your performance. So you're going to be looking at those lines. We call them trade lines. It's just anything that's reporting on your credit. So you're going to have credit cards, car loans, student loans, personal loans, things that you've borrowed money for from typically large organizations or companies, and then they report those to the credit bureaus. Every month, they tell the credit bureaus whether you paid on time, whether you were late, whether something happened, right? So a couple things can happen to accounts. If you don't pay them, they can go into collections, they can get charged off. So those are derogatory items. You're going to want to know if you have any of those on your account because it could create an issue when qualifying for a home loan. If you have derogatories at a very minimum, the underwriter is going to ask you what was the reason or what led up to it, what the resolution was, and where they are or what the status currently is. Now, things stay on your credit report for 7 years up to 10 years, depending on the account. So even if it was 5 years ago, there's still going to be a question about it. So just be prepared for that. So pull your credit report and look at all of those items so that you can actually know what it was, what happened, because if it's 5 years ago, the likelihood of you having to try to recall what it was is probably pretty high. I can't even remember what I ate for breakfast yesterday. So going back 5 years on the credit report might bring up some issues. Now, just because there's stuff on there doesn't disqualify you from a loan, but you will have to explain it. Now, depending on the time of when it happened, that could be an issue. Recent late payments, charge-offs, or collections within the last 12 months on a VA loan could stop you from getting the loan. And then with other loan programs, they're similar, but they could be a little bit more strict as well. So you want to know what your current status was, especially over the last last year, and then realistically, at least the last 2 years, you need to know what's going on with your credit report so you can answer any questions that might come up about those accounts. Also, fraud. identity theft. These things are happening. There could be something on your credit report that you don't even know about that could be an issue that you're not even responsible for. The other cool thing is that once you get signed up with the bureaus, you will get alerts. They love to send out emails, so you will get constant alerts as to what is going on with your credit. If there's been any inquiries, if there's been any new accounts opened, you can stay on top of that. Then you can also freeze your accounts. When you place a freeze on any one of your accounts, what that does is it stops anybody from pulling your credit, and then it gives you an alert. So that way you could stop any new accounts from being opened until you unfreeze it, at which point you could then open the new account with whatever lender, organization, or company you're looking at starting that with. So that's a little bit about credit score, what you need to know. Just get a good handle on it, stay on top of it. If you know what's going on with your credit report, it's a lot easier to manage, and you can stay on top of any issues that might come up. Number 2 here is work history. Let me go ahead and erase this up here. Work history. Typically, what we are looking at is the last 2 years. So at the very minimum, on the loan application, you're going to have to tell us what you've been doing for the last 2 years. We want to know that you've been employed, you've been working. Now, it doesn't necessarily have to be at the same employer, but establishing good, consistent work history will make you a stronger borrower. It will put you in a better position to qualify for a home loan. You've got 2 different types of ways that people basically make income or get paid, and you have W-2 employees, and then you've got self-employed. There are different standards. So when you're looking at self-employed, we're going to stick a lot more strict to the 2 years. You need to have 2 years worth of tax returns and owning that business to show history of it. Underwriters going to, at the very least, want your tax returns, whatever, and all schedules, whether you're DBA, if you do a Schedule C, if you're an S Corp or an LLC, you might have a K-1, you might just have a corporation return. They're going to want all of those tax returns, and we are going to take the 2-year average of that self-employed borrower, and that is the income that we will use to qualify that borrower on. Another thing with self-employed borrowers where we get in trouble are write-offs. Yes, they are good for business. I'm not an accountant, and I'm not going to advise on that, but just keep in mind and know that write-offs count against your income. So if you're writing a loss for your self-employed business, that could end up impacting the loan. Of course, you have to do what's best for you and your family and stay within the laws and regulations. But I've ran into multiple situations where we had self-employed borrowers, and unfortunately, COVID, other different reasons for kind of history that we've come out of, they actually had a loss over the last couple of years, so we had to report that as a liability. Yes, they owned a business. Technically, they were making money. However, the tax situation was that they were actually losing money, so we counted it as a monthly loss, just like a credit card payment, a student loan payment. Their business was a liability, and it is actually costing them money to run. So that's just something important to know about being self-employed. Now, your W-2 jobs, those are a lot more straightforward. There's some things that you need to know about your income. Of course, we can count your base pay almost immediately. Then if you have any variable income, commission, bonuses, incentives, we need 2 years worth of that. Also, anything like per diem, we may or may not be able to count that because technically that's income that you're being given to pay for something that you had to out of your own pocket. So it doesn't really look like income because we know that, okay, you traveled, you had to pay for a hotel room. So it's kind of a wash, right? They gave you money to pay for that. So at least there's no cost there, but we can't always count per diem. W-2, also when you're looking at transferring jobs, it's a lot easier and more straightforward. That's easier to count immediately. If you're a nurse at this hospital, then you go work at this hospital, right? Even if you're bouncing around jobs a little bit, that's not going to be an issue. Now, if you were a truck driver and you did that for 10 years for a company as a W-2 employee, but now you're switching to self-employed, we still need that 2 years. Even though you've done it, you're good at it, right? But now you're owning a business, and that's totally different from working for a company. So we still need the 2 years even though you were driving a truck and you've had that experience. owning a business. If you're 25% or more owner of a business, you are considered self-employed. And that goes back to that standard. Now, we can work it the other way a lot easier. If you were driving a truck, you owned your business for 2 years, now you're at a company driving a truck. It goes that way a lot easier. Again, we'll still need your tax returns for when you were self-employed, but switching to that W-2 job, it's a lot easier in that sense. So that's it when it comes to those two items, some of the main things there. Really, another consideration here is if I was thinking about transitioning jobs while I'm buying a home or quitting a job, don't do that, okay? You want to secure your financing. You want to secure where you're living before you really start making those big life decisions. We have had multiple situations where borrowers quit their job while we're in underwriting. You lose the loan that way. We can't give you a loan if you're not making money. And even if you're switching to another job, that could be an issue. All of the things I talked about before come into play. So even if you secure a job and transition while you're in underwriting, that could be an issue. So personally, if I was thinking about getting a loan, I would think about that in my job situation, right? I know the underwriter is going to be looking at this. It strengthens my position if I had good work history. I do want to switch jobs, but I can hang on for a couple of years, right? I don't need to do this right now. So that's just personally what I would be thinking about. Obviously, everybody's got to make their own decisions that's best for them, for you, for your family. But just consider the fact that there could be implications if you quit your job in the middle of the loan process. Don't do that. The next is rental history. So a lot of times we do have, that's a big space there, but hopefully you can, my perfectionism is not going to allow me to do that. I'm going to have to fix it here. So we've got rental history. We are looking again at the last 2 years. We will do what's called a VOR. So if you're with a management company, a property manager, somebody owns the home and they're renting it to you, we're going to do a VOR. So we are going to get your landlord's info and we are going to reach out and verify that you've been paying your rent on time consistently for the last 2 years, that there's been no issues. Something that comes into play here might be family, right? So if you are, or friends, and maybe no rent. So we do run into this situation where you're renting from a family, you're renting a room, you are not paying rent, you're living with somebody rent-free. That's okay. We just have to verify those things. So if you're living rent-free, we can do a rent-free letter. That is from you stating that you've been living rent-free with such and such person. And then that such and such person also writes a letter saying that you have been living there rent-free. Now, if you're staying with family or friends and you do have a handshake agreement, you don't necessarily have a lease agreement, there's nothing in paper or on paper, we can do a verification of rent. We will need bank statements. We will need something to show that you've been paying your rent on time consistently for the last 12 months, maybe 2 years, depending on the type of underwrite that we're doing. A lot of times we do manual underwrites on our VA loans, and in that case, sometimes we need 24 months worth of proof that you've been paying rent. And what that does is it shows the underwriter that you have consistency, you are good at paying rent, you can make a mortgage payment. Look, you've been paying rent for the last 2 years. But in order to verify it, we have to have proof of it. How do we prove it? Bank statements. We have to have something that shows it. A letter from you and the person's not going to work in that case. You can't say, yeah, I've been paying it. Oh, yeah, they've been paying it. You got to prove it. With that, we look at bank statements. You use any one of those apps out there to transfer money back and forth. It'll show on your bank statement. I would always recommend keeping it consistent. That's going to help strengthen your position. If every month on the 4th of the month, you see that money go out to that person that you're paying your rent, that establishes that good history for that borrower of paying rent. So rental history is very important. Make sure that you're always paying your rent on time and keep your records, right? Pay it through a bank, do a money transfer, don't do cash. If you do cash with a property management company, get a receipt. If you're doing cash with a family member or something like that, even a receipt is going to be looked at a little bit questionably, because It's not going to be an official receipt with any type of letterhead from a company. And those things can be forged and made up. Honestly, that's really what it comes down to, is that you can fake that stuff pretty easily. So always do it on your bank account where you can keep good records to show that rental history. The next thing that we're looking at are reserves or savings or savings. Okay, so this is just money that you have available to you as an asset. If anything happens, you've got reserves, you've got savings. So this could be retirement accounts, 401ks, bank accounts like a savings account or a checking account. If you have more savings and reserves, it puts you in a better position for a couple different reasons. First of all, you can cover any costs associated with the loan. Even if you're doing a USDA or a VA loan where there is no down payment, there's still these annoying little things called closing costs, right? And those can add up. And if you have that reserves or savings to pay for that, of course, you're going to need that to qualify for the loan. Now, you can get seller concessions, but outside of that, your reserves and savings will help you qualify, because if anything would happen to you, your job, you can still make your monthly payment. You can still make that mortgage payment even if you lost your job. So if you've got reserves for 3 months, 6 months, a year worth of monthly payments, monthly mortgage, that will put you in a better position. That's what we call a compensating factor, which boosts your position, right? So if some of these other things are a little bit more risky, right? So maybe you just started the new job, you've only been there for 18 months, you don't have that full 2 years, but you got a bucket of savings, right? You combine those two things together and that can strengthen your position. So anytime you can, whatever you can, doesn't have to be millions of dollars, anything that you can save up will help you strengthen your position. So always be thinking about how to save money, how to put a little bit aside, and how you can utilize that to your benefit when qualifying for a home loan. So I don't really have much notes to write about that. And then finally is know your options. Know your lending options. You've got some traditional lending, right? So I work for, we're a direct lender, but we can also broker out some stuff. Then you've got banks, and then you've got brokers, right? So they're all going to have their different requirements and guidelines, and loan to value requirements, credit score requirements, different things like that. So first, let's talk about direct lending or lenders. That's really what I am. We are a direct lender. However, we can shop your loan out to a few different investors for different products at times. So I'm kind of a combination between a direct lender and a broker. Now, direct lenders, they're usually doing QM products where it goes to, it's a qualified mortgage, and we adhere to the individual guidelines of those loan products. So Fannie Mae, Freddie Mac, VA, USDA, things like that. Banks are what you can call, not all the time, you know, there's large banks out there that do those QM products, but banks are, especially smaller banks, are portfolio lenders. And so what this means is that the money that they lend out, they keep it. So lenders, brokers, we give these out. These loans are then shopped on the secondary market, and they are transferred around like investments, right? They buy and sell them and swap them around all that time. With a bank, not all of them again, but your smaller local banks, those are going to be more portfolio lenders, which means they're going to hang on to it. They're not going to give them, they're not going to sell them on the back end. And a lot of them do more adjustable rate mortgages and things like that. But check with your bank and see what kind of products they have and what the requirements are. I've traditionally found that they have a higher down payment requirement and less risk threshold, right? They don't want that much risk, but sometimes the interest rates can be a lot better. So just look with those products, see what their options are, and kind of go from there. We did end up going to a local bank to get our current mortgage. And the reason we did that is because rates are going higher, and looking at a 30-year mortgage, the interest rate was about 2% or 2 points higher than what we ended up getting at our local bank. And that's because we went with an ARM, an adjustable rate mortgage, because we know we are going to refinance in the future, or at least that is our intention. I think rates might go down in the future. Of course, I don't have a crystal ball. Nobody knows what's going to happen to rates in the future, but I'm guessing or hoping that they're going to go down in the next 5 to 7 years. So that's what we got, was an adjustable rate mortgage where it's fixed for the first 7 years and then it adjusts every year after that. We're going to be looking at refinancing. And then brokers, they have tons of options. They can sign up with as many lenders as they want. They could be, 10 different lenders, 5, 20, 30, really however they want to do it. These are more of your individuals, self-employed brokers, and they can just shop it out and see who has the best rate, prices, and things like that. So there you go on your brokers. They have a lot of different options there. So, they've all got pros and cons. I think with lending, everything's in-house. So with us, you get your processing, you get your underwriting, everything's a structured system. With your brokers, they have to get all of that stuff and piece it together, and they can do a great job doing that, but then there are some issues that they can run into as well. So, the different underwriters and processors are hired by them, and they just kind of shop them out as needed, and that could be you can run into some problems like that where brokers are trying to get underwriters and they just can't find any of them, right? So different issues can come up with all of them. They all have their pros, they all have their cons, and it really comes down to what you need as a borrower to pick the one that's right for you and your family. And that's it when it comes to my 5 tips for qualifying for a home loan. Really know your situation as far as your credit history, get that credit report, go through it. You need to know more about your information than the lender does. So when they pull that credit report and they ask any questions about it, you'll have an answer to any questions that come up there. And again, it goes back years. Also stay on top of it, get any alerts. Time is of the essence when we're looking at fraud and things like that. If something's sitting on your report for 6 months, a year or more, and you don't know about it, not only is it going to impact your credit score, it's going to be harder to track down and resolve that issue. They're going to be like, well, why did it take you so long to get this resolved? Everybody comes from a different station in life, a different position. I'll meet you where you're at. I understand that. So, that's not always easy, but if you can at all, get a handle on your credit. Work history, establish a good work history, stick around at a job, get some mileage at that job, get some experience there, and show that you have stability at a position if you're thinking about getting a loan soon, right? You can change your job, you can bounce around, you can do different things like that, but always do it with the benefit in mind of showing somebody that, hey, I might have switched jobs 3 times this year, but look, it was once within the same company, so I stayed with the same company. The other time I transitioned to a new job where I was getting paid better, and then again, I moved to a better paying job. So if you're looking at the work history showing that each time you transitioned, it benefited you, whether that's schedule or money, you can kind of put that argument together that's best for you as far as your work history. Rental history, just always make your payments on time. If there's ever going to be any issues, reach out to your landlord and let them know, hey, this is what's going on. Can I pay you half now, half later? Please just don't report me late. All of these things, credit cards, lenders, car loans, dealers, things like that, they will work with borrowers, but they have to know what's going on. If you just ignore it, you don't make your payments, and you never tell anybody what's going on, they're not going to work with you because they don't have any context. You're just a number on a sheet, right? Late payment, late payment, late payment. But if you actually give them a call, I can't promise anything, but everybody, creditors, they're people too, right? So you can always try to contact somebody and say, hey, this is what's going on. I might be behind on a payment. Can we push this next payment out to this month? What can I do to avoid a late payment and get you paid, right? That's always the most important thing to a creditor that's lent you money. Get your money. They want their money. So rental history, establish a good rental history, never be late. Reserves and savings, anything that you can save, and even if it's just showing that, hey, over the last 12 months, I've been able to save $100 a month, you can show that with bank statements. That puts you in another position as well. When we're looking at these manual underwrites, the underwriter will look at that and they'll take that into consideration. Like, okay, you've been able to save some money, and really to them, it's irrelevant how much it is. To them, what they're seeing is somebody that's obviously budgeting their money, they're saving money, and they're strengthening their position, and they're actually being mindful about their position. right? Saving money means you have to budget, right? That's the best way to save money, is by budgeting. And then lastly, boom, know your options. If you know what you can do and the different requirements between each of them, that's really going to help you. And then depending on where you are, you might just need a map to where you need to be. So sometimes we don't always qualify right in the moment, but if we know what needs to happen to qualify, then you can get there. Just depends sometimes when, right? The goal is to own a home. Maybe it's not right now, but here's what you can do. Then you will own that home eventually, because that is the dream here, to get everybody into a home, become that homeowner. But how do we do that sometimes is the question. So hopefully this was helpful. 5 tips to qualifying for a home loan. If you have more questions, please feel free to put them in the comments or reach out to me directly. My information is everywhere here on my page and in the comments. I'm easy to get a hold of. Again, my name is Drew Smith. I'll see you in the next one.